Well, hello, everybody. The panel topic today is ESG and how we really weight it in our actual investment decisions. We'll start with introductions. Andrew is with us as well on the screen. So I'm Apwinder Foster. I've been the COO of DRC for many years. My focus now is on the investor and product creation side of our business. Antje?
My name is Antje. I'm investment manager at Aukera Real Estate, responsible for new investments and also for investor relations.
Yeah, well, my name is Yolanda. I'm heading DLE Group as a CEO, a company we co-founded in 2017, so a relatively new asset management platform that has different real estate product offerings. And one of them is a mezzanine fund that is actually considering ESG aspects in its investment decision.
Andrew?
Hello, hope everyone can hear me. Apologies, I'm not there in person. I'm Andrew Gordon. I run Invesco's European real estate debt business.
Great. So should we start with more of a general view, first of all, and what ESG means to each of us as non-banks and also to our investors? Because we all have slightly different products. So it would be interesting to hear how you think about ESG and how your investors think about it.
Well, I think ESG arrived right in the middle of the society, so even our children are learning about those questions in school and even preschool, how to protect our environment and which way is to go. We often hear that lenders say, okay, we're not in a driver's seat because we don't really own the real estate, and what shall we do? I disagree with this answer because we are an important part of the structure of the investment, and it's us who provide investors with ideas how to invest, and of course we can do something to bring forward the ESG development, of course.
Great. Yolanda?
Yeah, well, I agree with Antje. The pressure comes on the one side from the society, but on the other side, we as asset manager, we see ourselves as service providers. And on the investor side, I would say you could categorize basically the investors into three types, I would say. You have on the one side the believers that put pressure on that topic without being driven by regulation. So here I see mostly, actually I have to say, family offices, next generation that takes that topic really seriously. Then we do have, I would say, the second category, the restricted, let's call it like that, the ones that are pressured by regulation to change something and that are concerned and see they don't want to be and stay invested or have the risk getting invested in a stranded asset portfolio and see that it is time to really focus on ESG aspects. And then I would say there's a third category still, and I don't know to which category you in the room could relate yourselves the best to. I would say there's still a third category out there, which I would call the ignorant, that are usually, yeah, how should I say, if you mention ESG, getting some bad vibes and say, really seriously again, I'm not believing in that. That caused me so much pressure. I can't find any investment products. They get annoyed and they really don't want to talk about it. But I see actually the middle field being the biggest one. So let's call it the restricted, the ones that see they need to move ahead. While the last group, let's say the ignorant one, I have to say it surprises me and strikes me a lot that we still come across quite often of those type of investors. We heard from Patrick, actually the EU is putting tremendous pressure on getting climate neutral towards 2050. Setting high targets and giving that the building sector is here really the sector that is making a big contribution to the carbon emissions. I think Patrick mentioned 38%. So having really a significant impact regulation will get stricter, and the necessity for the investors, but also us as an asset manager, to here safeguard our investors' money is to really have a look that we are not getting invested in any stranded asset portfolio assets, where end of the day the assets are losing value because they can't keep up with actually the changing regulations here.
That's great. And we also see that third bucket, but we call them the less aware investor. Okay. But we find that those investors tend to be the smaller investors. So the size of investors and their internal platforms as well makes a difference to the focus, I think. So with our focus on small to medium ticket sizes, we tend to see that third bucket, but we see it as our responsibility as well to pull them up to the standard of the others. Andrew?
Yeah, we see the pressure in respect of ESG coming from all directions, really, which certainly is pressure that we welcome. Pressure from investors, as everyone has said, at different ends of the spectrum. Pressure internally at Invesco, where we are large direct managers of assets rather than as lenders, and as direct managers, clearly we have an ability to influence the ESG of those properties directly, and therefore pressure on us to ensure that we are lending to like-minded borrowers who also manage assets in the same way. But there's also a lot of pressure culturally and within our team at Invesco. Even though as lenders we are only indirectly responsible for how assets are managed, we're all keen to ensure we're doing more good than harm, and therefore lending on assets and lending to borrowers with the right motivations in mind.
Great. And so moving the questions around a little and continuing with the investors, do you think there is still very much a focus on target return over ESG for investors that you talk to, or do you think the balance is starting to tip a little more? You know, I have spent the past 12 months talking more about ESG than our track record in some cases, and responding to questions about ESG, and so it is really taking on a much bigger part of our overall due diligence and the assessments that our investors are making. But would the investor come and talk to us if the initial target return of our fund did not meet their criteria? So do you see, and I think it's an interesting difference again, because Yolanda, you have a very ESG target specific product, so it will be interesting to hear the differences between each of your products in that sense.
Yeah, maybe in general, and I struggle a bit with that question coming from the perspective return versus ESG. So I think ultimately going forward in the mid to long term, there should be not such a comparison, vice versa, because essentially ESG matters to safeguard your return. So if you fall short on ignoring certain ESG related risks, again, you might be ending up with a portfolio of assets that are quite expensive to keep up running, that are heavily taxed, that are heavily priced, where you potentially can't get your exit pricing anymore. So to really say, I don't care about ESG, or ESG is opposing return, I struggle a bit with that comparison, but I still see that it's oftentimes the investor's mindset. But end of the day, we are here to, on the one side, really deliver return, but deliver sustainable return. So return that is not there in the first, let's say, 1 and 2 years, but a return that will last over the next 5 to 10 years. So really safeguarding for the longer term here our investment portfolio. So I think there it's quite important to really have a clear focus on specific matters and keeping track about the changing regulation to really have, in the long run, the return that is required here.
Andrew, what do you think about whether investors care more about target or ESG?
Yeah, I'd certainly echo what you said, Atwinder, that some investors seem to end up talking about the ESG slides far more than we do about the case study or the track record or even the investment strategy, whereas others give us a blank look and we move on. I think at the moment there is a split between them. So I think investors who are not looking specifically at a green product don't amend their target returns, depending on how ESG focused the non-green fund is. But then investors do tend to have a different lower set of target returns if they consider it to be a green allocation. And just to build on what Yolanda said, I agree that whilst at the moment we have green funds maybe targeting lower returns and non-green funds that are still ESG minded, requiring higher returns, I do think over time those will blend into one as it becomes more obvious to everyone that if you are not fully mindful of ESG factors, in other words, what today would be considered a green fund, then over time the values of the assets you're lending against are going to start to fall. They'll be less resilient. And in order to keep those high returns, it will need to be a green fund. So I think there is a split at the moment, but we're moving slowly and inexorably towards a point where it is just going to be a debt fund, and a debt fund which is capable of hitting its targets will need to be a green fund. But we're not quite there yet.
Great. Antje?
Well, our investors are German insurance companies, and I think they are really front runners when it comes to ESG. They really want to bring ESG forward, and they like investing in green products and also green buildings. Nevertheless, I think it's not possible that each lender only lends to the best of the best, plain vanilla green buildings with the best certificates, excellent gold, bronze, or whatever. But I think we can do, and as alternative lender, as we are non-bank lenders, we can have a good product if we have a look at those buildings who are standing portfolios. So the stock is immense. So I think 80% or so of the transactions are with non-green buildings. And from our point of view, sustainability comes from looking for the right buildings who can be refurbished, or with CapEx programs, we can bring them to a better standard and maybe even to a green standard. And that's our main target, I think. And of course, for these kind of lending, you get higher income than for those plain vanilla green deals. Let it say like that. That's our scope.
Yeah. So let's talk a little about process before we get into how we use our process to make an investment decision and apply a weighting to the ESG part of it. So tell us a little about how you incorporate ESG into your due diligence and your screening and your sort of ongoing asset management, and then we'll come back to the actual investment approval and how much weighting you give. So let's talk through each of your processes a little.
Well, for Arcera, ESG and sustainability starts at the company level. So when you're looking for an asset manager, I think it's quite important to find someone who has a really stable team and who has a corporate setup that is sustainable. And from our point of view, it's quite important to incorporate a structure, also an owner structure of the investment advisor that really leads to sustainability of the team. And for example, we are all shareholders, and that's quite a good idea to keep the team together and to show commitment to our investments and investors for a long, long time.
Yeah, I agree with Antje. It starts actually at the corporate level, where you can set up a lot. But what really matters, in addition to that, in my view, is actually getting to the investment portfolio level and going deep as to go to the asset and actually the borrowers. So I think the real struggle right now is, independent how you rate certain criteria or weight certain criteria, is actually to have the data available. And that availability of data is what most asset managers or also investors are struggling with. And then most of the investors, I would assume, have on their side really their own rating mechanism to get anyway an evaluation of that data. So the way we approach it on our end, and I think the market is struggling here to find a common answer because there is no clear view on how to rate certain investment on ESG. It's more like everybody is making its own mind around it. How we did it, we developed a scorecard mechanism that is really bottom-up, evaluating each asset at acquisition. So means if we speak about mezzanine, and we're providing here mezzanine to project developers, looking at the development that is planned and rating the planned development on different climate criteria, sustainability criteria, energy criteria, but also looking at the borrower level. So also taking it to that side and looking how is the borrower, for instance, in terms of safety standards, accident rates, also having a classification and screening on the borrower, so the project developer. That is number one, so getting the data. I think step number 2 is actually then really, after you have collected all the data, evaluating it. And then the question is, what do you do with the result you're having? Are you okay to invest without having a great score, being fully aware of the risks? I think that's also a decision one can take. But the other decision is, and that is taking it a step further, looking actually, do I have a specific target as well in my fund that I want to achieve? And then thinking, how can I move my portfolio that I've rated on different aspects? How can I move my portfolio to that target and make sure that I can measure over the time duration of my investment process? So not only at the day of investment, but rather also in asset management, keeping track how it evolves over time. And the way, again, how we approached it is a scorecard mechanism at the day of screening when we take the investment decision, but also obliging our borrowers to provide the data input that we require to make things measurable over the fund duration, to always report that data and open their books to us so that we can have actually a mechanism to receive on a constant basis a feedback and really a new point, data point, where we see, okay, we stand right now with the overall portfolio here and there, and on that specific asset level, we struggled with asset XYZ and with borrower XYZ because of one of these X aspects is not fulfilled. So, but I think the very basic thing, and again, I think that is where the industry really needs data collection, is to start with the data.
Yeah. Andrew, how do you build ESG into the process?
Yeah, I very similarly, and I think consistent with a lot of lenders that I've spoken to, we have a scorecard. It looks at ESG factors across the borrower, the asset, and the business plan, and split between some exclusionary factors. So we won't go ahead and make the loan unless it meets those exclusionary factors, and then some assessed and scored factors, which are weighted across each of the S&G and each of the borrower, the business plan, and the asset to come up with an overall score. I think that, whilst, it's a common approach in theory amongst lenders, there is certainly no commonality in terms of, that questionnaire and those criteria that we look at, which clearly is an area for improvement across the industry. Not least from the borrower's perspective, it makes life very difficult if different lenders are asking different questions. And there are attempts going on across the industry to try and standardize the information that lenders request. And I think that will help speed up information gathering, help speed up transactions, and also help educate the borrower market about what the overall lender market requires. And I think that's where we all need to try and head towards, that if the lenders can speak in one voice about the information they require, then borrowers will hopefully start to respond more quickly. And from an ESG perspective, as I mentioned, lenders have only indirect influence. But I think this is the best way that we can start to use that influence to let borrowers know that unless they meet certain standards and provide certain data, they're going to find the debt market significantly less liquid.
I think that's the nub of the issue for us all, I think, Andrew, that the it's very comforting that we all have scorecards, but when our investors, and we have, close to 100 investors on our platform, look at us and benchmark us to our competitors, if none of those scorecards are consistent, it creates a real issue for our investor base. And so I think we have a unique opportunity at the start of this journey to sort of work together, and similar to LMA standards and other standards, we can sort of use the CREFC and INREV and other bodies to help to define some of these criteria for scorecards so that we're not all doing similar but different things, and make sure we can then build transparency from the get-go as well, I think is really the key to this topic. Let's talk about the weighting point, so the actual question. How much weighting do you give to, first of all, the E, the S, or the G in the ESG aspects of an investment?
Well, from our point of view, the E, of course, because we are looking at the building, we're doing a real estate due diligence, but this was done before ESG was a big theme, of course. The G is also important because we have to have a good look at the sponsors, which are their plans for that building or that portfolio he wants to get lending. Is there a real business plan? Does he or she really has identified risks out of ESG questions? So, for example, is there also already an identified asset that will be a stranded asset in 5 to 10 years or so? And is there a strategy, a CapEx strategy that will be implemented? That is one core due diligence point, and I think it's especially when you're not lending only those really core assets, the most important part of it, because the building is as it is, and it's quite the result from all our scorecards on the building will be maybe similar or not really a right range, but the difference is the sponsor and the quality of the sponsor concerning CapEx programs and improving the asset quality, lettability, and in the end, sustainability of the buildings.
Great. I mean, on our end, since we separated the 3 areas, our corporate level, the asset level, as well as the project developer as a borrower here, it depends which level you're looking at, how much we weight the environmental aspects, the social or the governance ones. The social and the governance ones are the ones that have, for us, the most focus on the corporate level. When we look at the borrowers, when we look at the assets, maybe starting here, it's clearly on the environmental side. When looking at the borrowers and the project developers, it's more on the social and governance level again. But there we need to be fair and realistic in the current market, and we are working here with mid-size and smaller-sized German developers in the market. When it comes particularly to governance, that's something where they feel quite overwhelmed if you have an expectation that they have a full set of manuals to regulate certain stuff. Then it's more looking really at how is the daily business really going on that scale, rather than looking at documentation that is in place. I would say also, if I compare a bit in an international scale, I have the feeling that the German market is potentially also lagging a bit behind in that regard. That it is really for a lot of market participants on that area also quite something new that they first need to get familiar with.
Mm-hmm.
Yeah, we start with the MSCI industry weightings. So MSCI has provided industry weightings across for each of ES and G across all industry sectors. And for real estate, they weight ES and G pretty much equally. And whilst I think that might be right as a sector as a whole, when you drill down and this is one of the complications in trying to come up with a standardized approach. When you drill down to different loan types, each of the S and G take on different weightings. So, for example, for a development which has the potential for enormous environmental costs, E is clearly more important. When it comes to different property sectors, then the social aspect can be very relevant. For example, if you're building affordable housing or hospitals, and then when you come to different borrower types, the G can be more or less important, very much depending on to whom you're lending, whether it's a small family office where you can't expect them to have such strong diversity and inclusion and broad non-exec board directors and so on, to much larger lenders where those things should be in place. So I think whilst industry as a whole, I think a third across ES&G is correct. But the complexity arrives once you start to drill down to individual loans. And that's, I think, why the industry so far has struggled to come up with a consistent approach. We do need to do it. I think we will do it, but it's not straightforward.
Great. And then to drill a bit further into the E part, following on from Patrick's presentation before us, when you look at the construction of your portfolios and you're looking at selecting investments to go into your portfolios, how much for the E aspect, the environmental aspect, do you give credit to the emphasis on physical risk or building certification or carbon emissions? So how much do you care about each of those topics individually? Or do they all form part of a sort of a level playing field when you're assessing your investments to go into the fund? So, for example, we will raise capital, we'll put 20 investments into that fund, and we will look at those specific aspects on every single deal. In our higher yielding value add funds where we can have more of an impact, we will be looking more at the carbon emissions, and there will be greater focus on how we're going to fix those issues through CapEx with the borrower. In our senior strategies where there are more stabilized assets, we'll be looking for good quality building certification, for instance. So as we drill into the E, what weightings do you put on each of the underlying components of the E?
I mean, one thing, and I think that's similar to what Andrew said, what is, let's say, the overall criteria is that we have some exclusion criteria, which are hard criteria. Yeah. But they relate also to, let's say, unethical investments, not so much only on the environmental side. Taking a step further than looking at really the asset, how we rate the asset there, the clear focus, as I said, is environmental related, and that goes into what are the energy safeties that we're having with that building, what is the use of sustainable materials, et cetera, et cetera. So on the asset level, it is for us the most criteria, the most important one. But again, the hard exclusion criteria that we're having are more related oftentimes to, let's say, unethical investments where you would say, do you finance certain things as a casino, etc., which are certainly far off but are clearly excluded from the investment strategy.
Great. Antje?
We do have funds which are set up separately, separate accounts for institutional investors. So, of course, it's a deal-by-deal investment strategy, so that we don't really have a target bucket for office or retail or other kind of use, for example, but we decide on a deal-by-deal basis. So, of course, during the screening, the first screening of opportunities that arrives on our desk, most deals which does not fit to our ESG profile, so the sponsor is not qualified enough and then too small or too difficult, or the building is already a stranded building, then we have to exclude and we will not present those deals to our investors. So I think it starts right at the beginning, at the screening process, and in the end, each deal is different. So each building is different and each sponsor is different. And it depends on the specific deal, which ESG aspect is the most important and the most difficult one. And we have to think about if it's acceptable or not to have ESG problems with some kind of transaction. That's well, best way to.
Yeah, I think that's exactly right.
Yeah.
We have all of our criteria are weighted equally when it comes to our scoring mechanism, but that is always reviewed subjectively because it could well be that one score is particularly low in one area but particularly high in another area, and then it is a case of reviewing it and deciding whether that is an asset that we should go ahead with. As I mentioned before, the contrast of assets which are doing socially good is always very difficult to weigh up against an asset which isn't as environmentally sound as we might want it to be. So all of the criteria, as I say, are equally weighted, but it takes a lot of subjective review over and above that to decide whether or not it's an asset we should proceed with.
Great. When you're in your investment committee, and it's slightly different again for you, Yolanda, because you have a fund which is targeting ESG assets, but I think the other panelists have ESG as a component of their funds. If you have, and I didn't ask you this question beforehand, if you have an hour for your investment committee meeting, how much time, on average, does your investment committee spend talking about ESG today? And where do you think that will trend to in a year or a year and a half's time?
I mean, my experience is more that it really matters at the phase where they take the investment decision, mostly. That there's a clear focus on those aspects and to really understand how are the ratings forms and what type of data gets collected and how it gets evaluated. So that is really more the discussion point at the point of when actually deciding to invest with us as a manager, yes or no. Which is also relating to understanding more conceptually the overall strategy. What is the approach here, be it, as Andrew mentioned, an exposure to social housing, affordable housing, rather than to luxury housing, or be it more focus on how do you understand green building aspects. While in the actual investment committee meetings, it's more driven, and I think, I mean, so far the discussions we had with our investors were really, they want to understand really the underlying asset, and coming again more from the commercial side and benchmarking side, and really trying to understand assumptions. Where it is not really so much of a real discussion point separately, ESG, but rather understanding in a full context the assets, which can touch down as well on the ESG aspects. What we do always with each of our assets in, for instance, our mezzanine fund, is that we are having also in the reporting and for those assets really the score available for our investors to really to follow through how we weight that. So it is available. I'm curious to see how much the discussion will evolve around that point. But so far, as we have it, we just started our mezzanine fund on this regard, so I cannot really speak of experience in this point, but more related to our other funds that are not debt related. The discussion point is more really broadly speaking, understanding the asset, and on some aspects it touches down on those aspects, but the clear focus is at the point of due diligence when they enter the fund.
Andrew?
Yeah, it's an interesting question. I think how much time we spend on ESG depends on, if you like, how easy a question it is to answer. So, for example, when we talk about in the investment committee the location of an asset, if it's a core location, we don't spend much time talking about location. If it's an off-pitch location, we spend a lot more time talking about it. And likewise for ESG, if the building, for example, has a BREEAM excellent rating, we won't spend a lot of time talking about the E element of ESG. But if it is a more challenging area, we'll spend a lot more time talking about it. But certainly when you look across the key things we spend time discussing at the investment committee of location, sector, asset, borrower, business plan, security package, and so on, then ESG is absolutely alongside all of those and gets given equal weighting when there are question marks about it.
Andy, do you have?
ESG is always part of our investment proposals, of course. And I think that the most important part is the sustainability of cash flows, of income. So the sustainability of the building is directly connected with this. And of course, the cash flow modeling is also one of the most important parts of the discussion about a new opportunity. And of course, as Andrew already said, if there's a building with a certificate, it's quite easier and it doesn't take so long time to explain the building itself. But the more asset management is required and the more CapEx facility is required, the more explanation is required for investors. Yeah, of course.
Great. We'll talk very quickly about, well, shall we round up 2 minutes? Just very quickly on borrowers and borrower engagement. We all try now to make sure our borrowers are engaging with ESG at the beginning of our investments. But what are we going to do if in 3 or 5 years' time our borrowers have not been able to deliver the underlying ESG targets we are setting? How are you going to manage that? How are you thinking about that?
Yeah, it's an interesting question. If you can outweigh or let's say pay for not fulfilling ESG aspects, so in a way if you fail short on delivering those targets that we agreed upon, if that is the thing which can be penalized with paying, for instance, a higher coupon on the loan, that is a debate where I think investors having different views on if that is a possibility to, let's say, pay your way out of ESG criteria. I think that's a very controversial topic. I don't know how you guys, Andrew and Antje, how you potentially have solved that on your end.
Well, sometimes it's the best idea to have CS in the loan agreement, so it's totally clear that there's a deadline for something, some information that should be sent to us, or setting milestones, for example, is also a good idea, I think, to bring them on the right track.
Yeah, I'm not sure we've totally solved it. It's an issue that arises in a number of cases. If you set CSs or you set targets in the business plan, the question is always, what will you do to use as a stick to beat the borrower with if they fail to meet those? And some borrowers know full well that just because you don't meet certain aspects of a business plan or you don't meet a CS, the lender is unlikely to take the full step of enforcing. So what do you have to encourage them to do what they're supposed to do? And typically putting in place some sort of a cash trap or holding some cash on day one to be released later, or taking the route other lenders have gone of starting with a higher coupon that can be dropped if those business plan objectives are met, are all things that we have thought about. But I think I wouldn't say we've fully solved it, but there certainly are a number of tools and levers that we've used both for ESG and for other business plan requirements that have been pretty effective in the past.
Great. Thank you.
Well, thank you so much, and Antje, Yolanda, and Andrew for this interesting discussion. I did get an email from Patrick, who just wanted to make clear, Yolanda, that he sees himself, because you mentioned family offices also as the first group, a believer, but not a believer for altruistic reasons, because it is a real threat to the business model, to everyone's business model. He mentioned insurance companies, climate challenges, and pension plans, also social issues. But I think we all are probably in agreement that this is nothing we need to do because of regulatory reasons, but because it is a threat to our way of life overall. So thank you for the insights. As we've already extended, and I think everyone is quite hungry for lunch, let's continue this discussion over lunch Also pointing out, Olli has a dedicated ESG conference that takes place here in Germany, where this topic is discussed even further. We'd love to see debt, also the debt perspective being integrated into that going forward. And we all can realize that this topic, again, it's an hour on the agenda, which is probably, again, too short. But thank you so much for sharing your insights. A big applause for our panelists and our moderator.
Thank you.